A dramatic shift is underway in the global commodities market, one that is quietly but powerfully redrawing the map of international trade. For decades, the world's most important metals changed hands in the financial capitals of London and New York, where prices were set and fortunes made. But now, the center of gravity is moving. The real action is no longer in the West, but along the vast and bustling border between Russia and China, where new trade routes are taking shape every day. Here, a new Silk Road is being forged, not with the silks and spices of ancient times, but with the industrial metals that power our modern world: aluminum, copper, and nickel. These metals are the backbone of everything from power grids to smartphones. Russia, once a key supplier to Western economies, is now redirecting these essential resources eastward, sending trainloads of metals across the border to China. For Russia, facing heavy Western sanctions and economic isolation, this pivot is not just a choice, it's a matter of economic survival and national strategy. For China, the world's manufacturing powerhouse, it's a strategic opportunity to secure a steady flow of discounted raw materials, fueling its factories and keeping its export machine running strong. This deepening partnership is reshaping global supply chains, forcing companies worldwide to rethink where they source their materials and challenging the long-standing dominance of Western markets. Russian metals that once fueled the factories of Europe and America now feed China's insatiable industrial appetite, powering everything from construction to high-tech manufacturing. The relationship is deepening further with joint ventures, new infrastructure, and integrated supply chains on the horizon. This matters for everyone, because the price and availability of everything from smartphones to electric cars, solar panels, and even household appliances are directly tied to these metals and the routes they travel. The era of a single integrated global market is fading, giving way to a more fragmented competitive world, one where new alliances and rivalries are being forged in metal, not just in words. The numbers tell the story. In the first half of 2025, Russia's aluminum exports to China surged by 56%. Rusal, Russia's aluminum giant, has made China its primary customer, rerouting output once destined for the West. Copper exports to China jumped 66%, fueling China's green energy and electric vehicle ambitions. Russian nickel exports to China more than doubled, underscoring the strategic nature of this partnership. These aren't just statistics, they represent billions in trade and thousands of jobs. Russia's pivot away from the West is deliberate and rapid, while China eagerly absorbs the supply. This is hard evidence of a new economic axis forming, built on mutual need and shared interests. The metals trade is now the currency of this emerging alliance. The world is witnessing a real-time reordering of economic power. The Russia-China corridor is now a vital artery in the global metals market. In the wake of the Ukraine conflict, Western nations imposed sweeping sanctions on Russia, targeting its vital metal exports. These measures forced Russia to urgently seek out new markets for its vast reserves of metals, upending long-established trade routes and economic relationships. Bans from the London and Chicago metal exchanges effectively slammed the door on lucrative Western markets. Suddenly, Russia found itself cut off from the financial hubs that once fueled its metal industry, leaving the country with limited options and a pressing need to adapt. Meanwhile, China, hungry for raw materials to power its ever-expanding manufacturing sector and ambitious infrastructure projects, recognized a unique opportunity. The country's insatiable demand for metals made it a perfect match for Russia's surplus. As the West turned its back on Russia, China stepped in, securing a motivated supplier, often at favorable prices. This new arrangement allowed China to strengthen its supply chains while Russia found a willing buyer for its metals. China's decision to abstain from Western sanctions made it the natural and almost inevitable destination for Russian metals, further deepening economic ties between the two nations. This push-pull dynamic has fundamentally rewired global commodity flows, forging a new axis of trade that binds Russia and China closer together than ever before. The partnership is pragmatic, not ideological, driven by necessity, mutual benefit, and the shifting realities of global politics and economics. Ironically, the West's attempt to isolate Russia has instead catalyzed one of the most significant economic realignments of the 21st century, with ripple effects felt across the globe. Today, Russia increasingly relies on China as its economic lifeline, sending a steady stream of metals eastward to fuel China's growth. The consequences of this dramatic shift are still unfolding, but one thing is clear: The global order is being reshaped before our eyes, with new alliances and dependencies emerging. The world is watching closely as two former rivals transform into indispensable partners, their fates now intertwined on the global stage. For China, the benefits are clear: stable, high-volume metal supply and leverage over a distressed seller. Russia's dependence on a single customer, however, is risky. China can negotiate lower prices, giving its industries a competitive edge. This partnership supports China's long-term ambitions, from infrastructure to green tech, but for Russia, over-reliance on China means diminished bargaining power and vulnerability to shifts in Chinese demand. Economic dependence could translate into political pressure, eroding Russia's strategic autonomy. If China's economy slows or changes course, Russia could face devastating consequences. Moscow is trading one form of dependence for another, escaping Western pressure, but risking new constraints. The relationship is a double-edged sword lifeline and potential trap. Russia's future now hinges on the stability and goodwill of its powerful neighbor. The stakes for both sides are enormous. The physical reality of this trade shift is daunting. Russia's vast mining operations, once geared toward the west, now face a new and formidable logistical frontier. Russia's mining hubs are far from China, separated by thousands of kilometers of rugged terrain. The infrastructure that exists was originally designed for westward exports to Europe, not for the long haul east to China. Rerouting metals east requires massive upgrades to railways, ports, and border crossings. Expensive, time-consuming projects that demand both capital and political will. New rail lines must be laid, border facilities expanded, and ports modernized to handle the increased volume. Logistical bottlenecks add costs and delays, eroding Russian profits. Freight often sits idle, waiting for customs clearance or available rail slots, while shipping costs climb and delivery times stretch. China, fully aware of Russia's limited export options, wields significant pricing power. Chinese buyers can negotiate hard, knowing Russia has few alternatives for its metals. As a result, Russian metals are often sold at a discount, with China acting as the price setter. The terms are dictated in Beijing, not Moscow. The journey to China is long and complex, involving multiple modes of transport and challenging terrain. This stands in stark contrast to the streamlined, efficient routes that once connected Russia to European markets. Russian producers are now price takers, forced to accept Chinese terms or risk unsold stock piling up in warehouses. The leverage has shifted decisively. The power imbalance is stark. China holds the market access and logistical upper hand. Russian exporters must compete for limited slots and favorable terms, while Chinese buyers enjoy a surplus of supply. Trade volumes may be high, but Russian profitability is lower than before. The costs of adaptation and the discounts demanded by China have taken a toll on the bottom line. The long road to China is both a logistical and economic challenge for Russia, testing the resilience of its mining sector and the flexibility of its supply chains. The new Silk Road may promise opportunity, but for Russia, it comes with a heavy toll, one measured in time, money, and lost negotiating power. The Russia-China partnership is evolving into joint ventures, signaling a long-term strategic alignment. Chinese companies are investing in Russian mining projects, including lithium, vital for the battery revolution. For Russia, this brings capital and technology after Western firms exit. Chinese partners fill investment gaps, helping Russia expand production and modernize its industry. For China, joint ventures mean supply security and insulation from global price swings. Chinese firms are becoming part owners of Russian mines and refineries, vertically integrating their supply chains. This deepens Russia's dependence as Chinese influence grows within these ventures. The relationship is increasingly hierarchical: Russia as resource provider, China as industrial and financial power. These joint ventures anchor the dependency, making future pivots difficult for Russia. The roots of this alliance are growing deeper and harder to untangle. Despite rapid growth, the Russia-China metals trade faces major hurdles. Infrastructure deficits, unfinished railways, ports, and border facilities limit trade volume and raise costs. Logistical bottlenecks make the supply chain fragile and vulnerable to disruption. China's price sensitivity means it could cut purchases if cheaper sources emerge or prices fall. Russia's advantage is political, not commercial. China's loyalty isn't guaranteed. Competition from Africa, Latin America, and Asia threatens Russia's market share. China will diversify its sourcing to avoid over-reliance on Russia, keeping Russian producers on edge. China's economic health dictates demand. A slowdown could devastate Russian exporters. Russia's fate is now tied to China's economic cycles and policy decisions. The relationship is transactional and potentially fickle. Structural vulnerabilities remain a constant risk for Moscow. Russia's pivot to China is sending shockwaves through global markets. Western companies scramble to replace Russian metals, driving up prices and competition. The world is splitting into two trading blocs, one led by the West, the other by China and its partners. This fragmentation makes pricing less transparent and supply chains more complex. Commodity-producing nations face new opportunities and challenges. Some gain Western buyers, others compete with discounted Russian metals in Asia. The global pricing structure for base metals is being reshaped. The post-Cold War order of open markets is fading, replaced by trade flows dictated by politics. The Russia-China trade is a prime example of economic interdependence as a geopolitical tool. New power blocks are forming, challenging the Western-led system. The map of global trade is being redrawn before our eyes. The consequences will be felt for years to come. As the Russia-China axis solidifies, big questions remain. Is this a temporary marriage of convenience or a lasting alliance that will challenge the West for decades? Can Russia maintain its sovereignty, or will it become a junior partner to China? Will other nations be forced to choose sides in this new economic rivalry? The answers will shape the future of global trade, power, and peace. We're witnessing history in the making. What happens next will define the world's next chapter.